What's coming next is even more voluminous. We have had a record 135 SME filings in September and 20 on main board. I'm Rishi Agarwal, co-founder and fund manager at Aarth AIF. We invest where India's growth is most under-researched, the MSME layer of capital markets. We are a Category 3 closed-end AIF with over 500 crore under management. And we have been ranked a top-tier performing closed-end AIF across India twice in last 6 months. Our edge is simple: discovery, scale, and exit. We evaluate opportunities across the value cycle: pre-IPOs, IPO, and listed, and size positions only when conviction and evidence shows up. Since November 25, we have assessed over 200 IPOs and deals, secured anchor in 50 plus IPOs, applied for many QIBs. The result is simple: 45% XIRR driven by discipline, not hype. What makes this possible isn't just a framework, it's muscle memory. Our leadership experience spans across broking, wealth management, merchant banking, and risk management. This mix lets us read our offer document faster, pressure test unit economics, and crucially price time. It's also given us success and access to long-standing relationships with all capital market intermediaries and a reputation for turning due diligence into decisive allocation. Let's take a step back as we closed September 25. Globally, we are in a transition. Geopolitics is noisy, trade confliction and friction continues, power is shifting. The signal, the Fed and ECB are effectively on pause. Rate hikes look behind us. Future moves will be data-driven. Now the quick scoreboard is as follows. US growth resilient, inflation roughly 3%, unemployment also in its low furrows. China growth is slower, inflation near zero, and unemployment is in mid-fives, which is worrying. South Korea, exports are stabilizing, inflation around 2%, unemployment in mid-2%, so that's also fairly stable. India, our GDP grew 7.8%. Even if I take an inflation of 2.5%, which is what we had after a very long time, we have over 5% real growth. Now, markets at home in India, the index Nifty 50 has been range bound. Even mid caps and small cap haven't given a lot of upside. Foreign flows have turned mildly positive. Domestic flows are still buying and cushioning the volatility. On the big story for September, on main board we had 25 IPOs raising over 13,000 crores. This has been the busiest single month in decades for main board. On SME, 53 IPOs raised mere 2,500 crores. A good record, heavy volumes, very noisy. Now what's next? You must have thought all the heavy lifting is past. What's coming next is even more voluminous. We have had a record 135 SME filings in September and 20 on main board. Bottom line, the macros are cooler in West. China is still discretionary. India inflation is unusually low. Liquidity is alive in primary markets. Yes, breadth is only gently positive. That's the environment to price time, demand unit economics, and back promoters who live by their numbers. If we focus on SMEs, current valuations, and how they will function, the answer is short. We are attractive on also stretched. And to evidence that, if we segment the 886 listed SMEs by market cap, the 3 buckets stand out. And I'll give you the PE range on each bucket. 0 to 100 crore bucket, 39 earnings, fairly high. 100 to 500 crore, 22 earnings, fairly reasonable. And over 500 crore, 30x. The 500 crore bucket especially is 30x because that is how mainboard companies are looked at for longer growth and longer tenure. Now, in many SME indexes, you would have seen 3 to 5x growth in the last 5 years. But the average real story is dispersion. On one side, you have high quality SMEs where clean governance, good cash flows and balance sheet, predictable earnings, low PEG ratios, fairly move the PE to single digits in over 3 years. On the other hand, you have some very thinly volume traded companies where earnings are barely visible, growth is priced perpetually as if the companies will stay for 30-40 years in business. That's momentum talking, not fundamentals. So how do we disperse the two? At Aarth, our stance is simple. In large cap, usually there is enough information by brokers and researchers and most information is aware to everybody. In SMEs, information asymmetry is alpha. But only if you execute with institutional discipline. That's why we go beyond P&L. We study management intent, quality audit, working capital, and peer benchmarking across the peers. We track conversion cycles, customer cohort, and promoter behavior, especially under pressure. When balance sheets strengthen up and you see visible growth or a few catalysts, the game is loud and clear. We see multiple growth. May not be uniformly across the sector or the segment of MSMEs, but if you do enough deep value research, the size and position with patience will give you great compounding numbers. So in crux, MSMEs are both frothy and fairly valued, especially in the middle segment which I had spoken about. There are a few sectors which I see SMEs have prominently stood out, not because those sectors have really had headwinds or tailwinds. We are sector agnostic as a fund. A few structural themes have even then emerged out where SMEs have had a fair advantage either because of structural change, government push, or an upgrade to the economy as a whole. The big picture I see, which I have not seen in decades, is Indian engineers are turning entrepreneurs. Talent that once chased overseas jobs is building at home, faster cycle, tighter feedback and real ownership. Renewables and energy transition is being the leader. You have seen many storage component companies, energy storage companies, grid modernization being led by MSMEs only and only because in last 3 decades, there has not been much innovation, there has not been much capital expenditure by the larger players, and even if they have done it, they have been laggers in doing so. Engineering and manufacturing, as I spoke earlier, we are continuously seeing a demand by every Indian to have better engineered products, better manufacturing, better quality, and premium products are getting the prize. And this is not just the case in urban markets, it's more so the case in rural markets. Third area is tech-enabled B2B platforms. Mind you, B2B platforms, not B2C. Why? Because B2B platforms have had multiple operational pain points across decades. We didn't have enough systems, our tech people were not trained enough, logistics and warehousing were very expensive. All that is falling into single digits in terms of cost. The awareness, the information arbitrage is reducing because of social media. And if you do a cohort retention analysis, take study take rates, have a negative or light working capital with right unit economics, the improvement is phenomenal in this segment. There are a few macro trends which will impact SMEs in October 25. I see 4 which I can discuss with you in this short time. One is festive season demand. We have seen the GST cuts. We usually see a great demand uptick in Diwali, which we didn't have the last time. It was fairly muted. But this time, when I go to malls, when I go on the road, when I see construction, new homes being built, it's pretty much all-time high. And you will see great GST numbers coming in October, mind you, even though we've had a cut in GST percentages by half. In fact, Maruti plans to open 3 more plants in next 2 years. And guess what? They've only had 3 plants in the last 30 years in India. So there is a real indicator of demand, right? Rising demand. Now, coming back to the biggest thing in India, elections and the policy push. So we are seeing a great spike in infra push, rural housing and last mile schemes led by both central and the state government. In fact, I've seen many companies bidding for large projects with larger players in Northeast, Bihar, Orissa, where they're getting higher margins because the bigger players are not taking the risk. They don't have the bandwidth or the footprint in these areas. We are likely to see great state budgets and MSME spending influences by them. Thirdly, you have credit flows to MSMEs. So once you have a base level of equity in MSMEs, NBFCs and banks are just waiting to provide capital. The risk is with 5-10 crores of equity, banks are really jittery. And at a scale of almost 30-40 crores of capital, you as an MSME can afford to have all the processes, checks, balances of finance controller and a good auditor. And fourthly, I see global trade and input volatility being an uptick for us. Why? Because we have been jugadus for quite some time, right? And we have seen that the freight and crude prices have been fairly normalized in our economy. Now, with that and a push from the government, we will see premium products being built in India, supplied globally as a construct of our polity, as a construct of our sustainable policy, so that there will be no shocks like you may see in other economies which are not democratic. And also, we have always appreciated IP as a country. I have never heard of many IP infringement cases being done against Indian or Indian companies because we are fairly scared. We are God-fearing people in that sense. If you dive into my portfolio of the fund, we have ranked second across all AIFs, category AIFs in July with 5% return in only July month. In terms of deployment, we have deployed over 90 crores in 28 SME anchors and mainboard IPOs, and many more on screen. Our focus has been MSMEs. Even on mainboard, we look at companies with a PAT of roughly below 200 crores. During this quarter, we have built exposure to following sectors. There again has been a construct of just stock picking and company selection. Industrial engineering being one. Second is infra-linked businesses, not just infra-linked businesses too, be it IT, design. Design has been really uptake for us because we see quality design being paramount for quality infra in India. And energy transition. We are seeing a sharp order inflow from the government and private companies. We have seen a lot of companies in India looking at the capex never before. Especially the consumption story is just going crazy. We've deployed the capital in areas where we've seen stronger risk-adjusted upside. So we are not a passive fund. We don't invest and forget. We're fairly active. And we've had roughly 50% of all gains in realized gains. Growth potential and governance clarity has been too clear filter for us. If either fails, we pass on the opportunity. And we are flooded with opportunities and deals every day. Let me leave you with this thought. Large caps are about the efficiency of capital, whereas MSMEs are about the inefficiencies of information. And within that inefficiencies lie the next decade's opportunity. At Aarth, we are not chasing the noise. We are building conviction in businesses that may survive shocks, scale quietly, and deliver steady compounding. India's growth story will be written not just by the giants, but by hundreds of emerging enterprises that form the backbone of our economy. And our goal at Aarth is simple: to find those enterprises early, back them responsibly, and participate in their growth journey. Thank you.